Because who's paying for this in the future? It's not me. It's not you. It's going to be your kids and your grandchildren. I mean, they're going to look back at us and go, wow, that's a great generation, man. They spent way beyond their means, hogged all the resources, and now that we're ready to do stuff, there's no money left. Okay, third short story, House of Mirrors. This is the U.S. financial system. Here's what this is all about. How about tips with a negative yield? How about a low volume in the stock market? They've been complaining about low volume all year, and 50 to 80% of it's in high-frequency traders. And then you find out that some of the biggest banks in the country are making a profit every day for an entire quarter. 100%. How's that? That's pretty good trading when you can trade every day and make a profit every day for 90 days. That's a good gig, especially when you can borrow from the Fed at nothing and do it. I'm in on it. Count me in. Almost all retirement funds are going into bonds and flooding out of stocks. Everyone's buying gold out of fear of a government that will be unable to live within its means. Huge investors are selling dollars and buying commodities. I know some of you own gold now. People don't laugh as much about my recommendation about if you're going to buy gold, take cocaine instead because at least you feel good before it kills you. People don't laugh at that anymore because 3/4 of the audience already has a long position in it. And their wife's there and going, hey, shut up, man. I just told my wife we just bought 50,000 because I saw that on Glenn Beck. He said, buy gold. I'm telling you, you talk about a sell signal for gold. I mean, the only commercial that I see more frequently on TV than Cialis commercials is buy gold. It's just like a big neon sign. You better sell, you better sell, you better sell. Because if his boss ever gets comfortable that the economy is going to turn the corner, he's going to put the brakes on with higher interest rates. And when they do, the value of the dollar is likely to come up. And that price of gold and that price of oil and the price of cotton and all that stuff. I hear gold traders saying, we're long on gold, but we got our finger on the trigger. So if you got a position in gold, you better not go to work for the next 90 days because they got their finger on the trigger. All right, let's see here. That's good enough. Oh, just one for the road. Remember those derivatives that were such a big problem 2 years ago? We're going to take care of those. I just found out yesterday or last week when I put this together, there's still $615 trillion outstanding in derivatives. So, oh well, whatever. More House of Mirrors here. We've got bank regulators telling Texas to keep their powder dry. I gave a speech at the state convention, the independent bankers, and the regulator came in, not Bill's outfit in Texas, but one of the Washington ones, came in and told all the bankers in our state, we're one of the strongest states in the country, our banking system is one of the strongest in the country, and their regulator came in and says, I'm worried about your commercial real estate loans, I don't want you to make any, but I'm also worried about your excess liquidity, and told them it's okay to buy treasuries. So the regulator came in and told all of our Texas banks it's okay to buy treasuries. In the Q&A, I just said, sir, do you understand the economic consequences of this policy if all the banks in this country don't make any loans until we, quote, get out of this thing, which is what he said? We need some changes in that regulatory environment, and that's a thing that a place like ULI can do. Get a little subcommittee going and try to build a case. There's a big difference between making a real estate loan for a subdivision with 5 homes that are $1 million apiece, spec homes, and a loan to a doctor that's opening up a clinic. He's going to be an owner-occupant. And those are lumped in the same category according to the regulators, and they'll come into a bank and say, you better not make any more real estate loans or we close your bank. Okay. Tax credits have distorted the housing market, now created a negative environment again. Nobody knows whether the housing market's going to recover or not. That tax credit was a bad idea, in my opinion, because the market was bottoming out. It was going to be slow to come back. So what do? We goose it with a bunch of steroids for 3 or 4 months, and then you have a vapor lock of demand on the other side. And now, as we said here today, we'll have to wait till next May to know how we can answer that question. Because we have to wait till next May to be able to say sales in May compared to sales last year are better. Then we'll be able to say the market's clearing. Just because home sales are off 30% compared to the same time a year ago, that's meaningless. That doesn't mean a thing. Because you had tax credits last year, you don't this year. Franny destroyed itself and after 3 years, nothing's been done to repair it. Why is that? Ask the people that you're involved with, what is your excuse? How come you haven't fixed Franny already? What are we waiting on? There's nothing magic to this. I'll be happy to share a few ideas with you if you're interested in doing this sort of thing. This is political stuff, period. Government regulation of our banks and government regulation, manipulation, whatever you want to call it, of the mortgage market, Franny in particular. These are political issues that need to be solved. These are not bang the piñatas anymore, and every month and year that goes by that these aren't fixed is another month and year that commercial real estate volume and residential real estate volume is retarded dramatically. All right, you can read this stuff later. I will say this, there's a double bubble developing in commercial real estate. It's even starting to hit Houston now. The sad part of things are the commercial real estate market, if it would start to clear right now, there's all kinds of excess demand for commercial real estate. All these people raise billions of dollars in equity money, and they're about to have to give it back. They're looking for deals to make, and the market won't clear, and I want to get to that next. All of this said, I'm building a case, and I've already invested in it myself, that commercial real estate is going to be a hot investment asset class within the next 3 to 5 years, for sure. And the only reason it's going to be 3 to 5 is just a question of when will the FDIC and the Federal Reserve Bank allow the banks to sell the distressed commercial real estate. There's a lot of demand out there. Okay, so here's my last story, the Pillars of Hercules. When will the banks sell their distressed commercial real estate? That's a fundamental question I've been asking all over the country all year long, and I can tell you nobody has an answer to this question. Not one person has an answer to this question. Okay, what do we got here? I want to describe this because I've got 7 minutes left, then we're going to have time for Q&A for 15 minutes. When will the market clear for commercial real estate? If you didn't know this, commercial transaction volume's off about 80%. It's been off for a long time like that, like almost 3 years. And it's not just real estate brokers, but also leasing agents and mortgage brokers and lawyers that specialize in real estate transactions and construction firms that do T&I improvements, tenant improvements. All of those people, their business is off 80%, and it's important that this market start to clear so that we can start getting some jobs back in there. So here's how it works. Let's say a building owner bought a piece of property for $1. Let's just say it's $1, and they got a bank loan for 85 cents. And that's now called a commercial real estate loan, and this is what the Office of OCC loathes so much and is telling all the banks, including Texans, not to make these loans right now. Now, everybody seems to agree that a bunch of commercial real estate in this country dropped by 40% in value. Whether it's the NCREIF index or the MIT, whatever that one is, or the account that I'm in, TIAA-CREF's real estate fund. All of those dropped those big portfolios of institutional grade properties by 40%. Okay, so here's the deal. The bank, the owner bought at $1, the bank had an 85 loan, and now the property's worth 60. So the bank's got a 25-cent loss. Now, under normal circumstances, the bank would sell that property, take the 25-cent loss, and move on. That's how things typically work. Why won't they do that now? Why haven't they been willing to do that for almost 3 years? Well,